Hello and welcome to Advanced Projections November 2020 Economics Report. Let's begin this month with some good news. Our expectations for a 15 to 20% decline in corporate earnings for the third quarter of the year were too pessimistic, as it turns out. To date, the decline has only been about down 7.5%. which is still the third largest quarterly decline on record. But it shouldn't get any worse than this as earnings season comes to completion. Although the S&P lost almost 3% during the month of October, the reaction since then to the election results appears positive in the short term, sending the markets back to slightly higher records back in bubble territory. More on this later in our report. Now for the usual bad underlying news. We said last month that our expectations for COVID cases and fatality tolls would continue increasing through the end of the summer, i.e. late September. As of now, November 9th, U.S. cases reached just over 10.1 million, an increase of more than 2.5 million in the past month. New cases have soundly passed the rate of 100,000 per day, and U.S. fatalities have reached 238,000, up approximately 28,000 or 13% in 1 month. Fatality rates, which are fatality cases, fatalities divided by the number of actual cases, remain stubbornly near 2%. Based upon average daily infection rates at the end of September compared to average daily fatalities 4 weeks later. These numbers imply that an overload of the healthcare systems is in the offing again. What we saw happen in New York City in late spring is likely going to happen in the new hotspots in the Midwest and Northwest states. Effects on transmission and mortality are anticipated to move higher again due to continuing indoor business and education activity expansions and cooler autumn weather, which implies that people are staying indoors more and in closer proximity to one another. Holiday gatherings are coming up as well. Due to more stringent pandemic controls in other countries, they did not experience a midsummer second wave like the USA did. We are now in our third wave, one ahead of most of the rest of the world, and still at the top of both the total cases and total fatalities lists. In spite of having only 5% of the global population, we have 20% of the cases and fatalities. A larger second wave of infections has clearly gained momentum in Europe. Nearly all of the countries in the top 20% of those ranked by new cases per 100,000 population are European, with the notable exception of the USA being a member of that list as well. India had a rapidly increasing number of cases 1 month ago, but their new data implies a significant roll-off in their new cases, down to about 40% of what the U.S. new daily case count is averaging. Globally, we expected cases to reach 35 plus million a month ago, and now they are at more than 50 million, up drastically in just 1 month. That's an increase of more than 150% from the 19 million at the beginning of August. At this moment, there are nearly 500,000 new cases being reported daily and still increasing. By the end of the year, it would be a reasonable expectation for a global case count to reach at least 80 million, perhaps much higher, and far higher than we originally anticipated. Global fatalities have reached just past 1.2 million, and it is likely that this number will be at the 2 million point by the end of 2020, just as we projected in our October report. Last month, we mentioned the downplay and happy talk surrounding the pandemic situation. Reality had come home to roost when the president and over a dozen of his personal contacts began reporting positive COVID tests and symptoms. More White House infections at the top levels are now being reported, including the White House Chief of Staff. Given the latency time between exposures and the evidence of infection, this likely will expand to encompass many more individuals within the highest ranks of the U.S. government, as well as individuals who attended trips, meetings, and rallies which were held during the initial phases of this infection vector. It is only through the availability of extraordinary care and application of new experimental treatments that so far has prevented more serious consequences. Given that this is a clear demonstration of the consequences of ignoring best medical advice, we should be more realistic in our own expectations. It would be optimistic to presume that under the best of circumstances, it will be mid-2021 or later before a large number of people can be given one of the vaccines currently under trial, and it will be late 2021 or beyond for an available national vaccination program. One promising vaccine announced just today on November 9th has perhaps reached the point of being able to soon apply for an FDA emergency use authorization. As the 2020 flu season begins, we continue to hope no new extraordinary challenges show up, now that global vigilance should be at peak levels. We also hope that the outgoing administration does not sit on its hands for the next 2.5 months and instead takes further actions to help control the pandemic and its economic consequences. But that may prove to be an unrealistic expectation. Now, for the current economic environment, in October, unemployment levels declined again somewhat to a national level of 6.9%. Again, with most of those returning to work having been temporarily furloughed or had their hours curtailed from their jobs in mostly service industries. Many more of the remaining temporary layoffs have become permanent ones, and the hardest hit industries have continued with rounds of permanent layoffs. We anticipate that during the next few months, return to work gains will flatten further as outdoor seasonal work hours decline. Anticipating a fresh set of holiday-related infections in the ensuing weeks, we think unemployment may yet move back up, returning to the 8 to 10% area, but that will depend entirely upon the social and political responses to the massive COVID wave that will be happening in the coming weeks. Equities markets appeared to have peaked ahead of the election and during the week of vote counting. New highs were set in the first 2 days of September, and then the markets retreated about 5% during the rest of that month. October witnessed a further 2.7% decline in the S&P 500. We issued blogs in late September and late October about potential market responses to the election results, and would refer you to those for details beyond what we normally include in our analytics. Election results and post-election political behaviors now have to be factored in, more or less in real time as they unfold. Generally, markets hate uncertainty, and we observe that it is the nature of the current outgoing administration to amplify political uncertainty. Here's our AP individual indicator information. Our AP-SI indicator looks at the relationship between current month-end S&P equity closes and the ones from 4 weeks back, as well as comparisons to a set of long-term growth rates. In September, we published twice about the 3 indicators we use to establish whether markets have entered bubble territory. That is the best place to look for details, but we summarize here that the highs set in early September forced the tripping of our third of 3 bubble indicators, and that the subsequent minor retreats of the markets haven't changed that picture. Now, new tests of those highs have just occurred within the past few days. In spite of better than expected third quarter earnings, the PE ratio of the S&P 500 increased to a point of double where it should be under normal circumstances. If this index remained absolutely flat, corporate earnings would have to increase year over year by roughly 25% for 3 solid years just to get back to realistic index valuations. This is an unrealistic expectation, to put it mildly. We will be watching market performance and growing margin borrowing levels, our favorite tool for tracking speculative excess. The last peaks in margin borrowing showed up before the two large corrections of 2018, both of which we predicted. During the recession, margin debt has increased by nearly 40%, absolutely flying in the face of the recession and realistic prospects for the economy going forward. At an estimated $665 billion, margin debt is a mere $35 billion away from its all-time high of $700 billion, set at the end of 2017. Right now, it is about where it was when we warned of the first market correction of 2018. Circumstances are vastly different now, but heavy margin borrowing, synchronized with markets at highs, is a likely driver for a market correction beginning, quote, soon, unquote. Last time we said this, the correction began within 3 months, and it came in 2 waves during 2018. October's closing value for the S&P 500 shows up as a yellow APSI indication, with that index in warm but not blatantly overheated territory. Look for a return to red if that index closes out the month either above 3570 in an overheated state or below 3270, correcting downward rapidly. Other indicator statuses. The AP-MS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, now reaching $18.6 trillion, up 20% since the first of the year. It also continues to warn Congress that the bottom layers of the economy are still suffering and the whole economy will suffer lackluster growth if no new and significant stimulus is injected there. Additional stimulus has been dangled at us by some of the Congress, but negotiations on further stimulus were called off by the White House a month ago. There was an immediate negative reaction to putting off any further stimulus hopes until after the election, and now, even though we hope differently, it is a realistic expectation that nothing more will come before the new administration and new Congress take the national helm in late January. The GDP rate picked back up during the third quarter from the second quarter's $19.4 trillion per year to a nice recovery value of $21.1 trillion per year. We now expect small further increases in both the GDP and the velocity of money, a turnaround from our expectations just 1 month ago. More about this at the end of this report. Precious metals have steadied now as all were showing upward price movements at surprising rates of increase earlier this summer. Gold spent all its time between $1860 and $1960 per ounce in September and October, down from August's temporary push above $2,000, which penetrated that mark for the first time in history. Silver behaved similarly during October, staying in the $23 to $25 range. Rhodium continues dancing within a range for the time being, remaining near all-time high levels. There will likely be some additional sideways moves in precious metals along with the equities markets in November. Month-end pricing for gold and rhodium keeps our AP-PM indicator well into the red. The September LEIs from the Conference Board again improved slightly, but for this report, our AP-LI indicator remains in the red. We expect lackluster leading economic indicators to continue within the next few months. The Conference Board also warns of a flagging recovery and that we should expect a weak economy well into 2021. Due to the depressed yield curve, our APYC indicator remains yellow for this month. All Treasury short-term yields held at levels very similar to last month, while longer-term yields moved up about 20 basis points, reflecting a tiny bit more confidence in the economy. The Federal Reserve's weekly aggregate measure of economic stability has returned to a position of relative safety, but the Fed itself has remained with the NBER declaration of recession within all of their data sets. Fed charts for other data that we observed clearly show that they have not cleared the bottom of the recession, and Recession 2020 is now 8 months in extent per the NBER. Therefore, our APFD, or Fed indicator, for this report remains red now for 8 months straight. This may change shortly because as the third quarter 2020 GDP grew substantially upward from its enormous decline in the first half of 2020, the traditional measure and definitions of recession have now pointed to a technical end of Recession 2020. The NBER nor the Federal Reserve have yet to take official notice of this technical end, but Advanced Projections is going to declare 2020 recession as being now over, approximately 8 months after it began. But we do make ominous note here that the root cause of the massive collapse that characterized the onset of Recession 2020 has not gone away. COVID is getting much worse, and control of the situation will determine if there is a second dip and perhaps a Recession 2021. Real-time events will determine this, as the majority of our standard set of indicators have not yet even returned to green states, nor do we expect them to do so for many, many months. We will have to basically rely on a direct watch of GDP and financial stability indices for several months, which are inherently less reliable short-term indicators. So in summary, only one of our 6 indicators is in green territory. We are dropping our probability of a near-term recession to 80%. We calculated that the actual onset of a recession had already begun over 8 months ago, a fact which was then confirmed by the NBER in June, and it became officially acknowledged by the Federal Reserve later in the summer with the adoption of NBER's declaration within Federal Reserve datasets. However, as we just noted above in bold text and verbiage, the technical end of Recession 2020 has now occurred. Further modifications to this scenario will depend on what happens in the days and weeks ahead. Reviewing the events leading up to the Great Recession, there was a brief rebound before the serious declines of late 2008, within the context of an unbelievably risky economy, just as we are facing now. Just like then, we have now faced an election which portends a shift in administrative policies. This time, there is the unique backdrop of a worsening pandemic and an ongoing political manipulation of social and economic expectations. We maintain that this is a very risky equity market environment with potential for significant and protracted drops. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean, or worse, becomes more likely with each new disruptive influence. That's it for this month. If anything big shows up between now and the first week of December, we'll probably put out a blog and inform you what we think is happening. Thanks again for being a subscriber, a listener, and a supporter of Advanced Projections.